Okay, we're back on page 268 with example exercise 6-4. And it says Ross Company purchased merchandise on account from a supplier for $11,500, terms 210, net 30. Ross Company returned $3,000 of the merchandise and received full credit. If Ross pays the invoice within the discount period, what's the amount of cash required for the payment? So we would take our $11,500, subtract the $3,000, that would give us $8,500, and then take 2% of that, which would be $170, and subtract that from the $8,500. And it says under perpetual inventory, what account is credited by Ross to record the return. So let's take a look at our solution. I think our answer for the amount of cash required is going to be, well, we'll take a look real quick. Yeah, $8,330. The $11,500 minus the $3,000 would give us $8,500, and then 2% of that's $170, and we subtract that from the $8,500, and we get to $8,330. And it wants to know what account is credited when we return merchandise. We would credit the merchandise inventory account. Okay, let's talk a little bit about freight. Freight, it says, if ownership of the merchandise passes to the buyer when the seller delivers the merchandise to the freight carrier, it's said to be FOB, free on board shipping point. And what that means to the buyer is if it gets damaged while it's being shipped, it's the buyer's responsibility to file the freight claim, because the buyer owns the merchandise as soon as the seller delivers it to the freight carrier, and that's called FOB, shipping point, free on board at the shipping point. It says Net Solution buys merchandise from Magna Data on account, $900, terms, FOB shipping point, and pays the transportation cost of $50. So not only is the merchandise trade hands at that point, the seller actually, or the buyer actually pays the shipping cost. So Net Solutions would debit their merchandise inventory $900, credit their accounts payable $900, and then debit the merchandise inventory $50, and then credit the cash $50. And it says paid shipping on merchandise purchased. If the ownership of the merchandise passes to the buyer when the buyer receives the merchandise, it's said to be FOB, destination, free on board destination. Now in that case, the seller owns the merchandise until the buyer actually receives it. And so that means the seller is actually going to pay the freight on that merchandise. So if we look at another example, Net Solutions, Net Solutions is seller in this point, sells merchandise to Krantz Company on account, $700, terms FOB, destination, and the cost of the merchandise sold is $480, and the freight is $40. So let's take a look and see how we would journalize that. We would debit our accounts receivable, $700, credit the sales, $700, debit the merchandise sold, $480, credit merchandise inventory, $480, and then debit delivery expense, $40, and credit cash for $40. Because Net Solutions, if it's free on board destination, that means Net Solutions having to pay the shipping, and actually still owns the product until it's received by the buyer. So if it got damaged, Net Solutions would have to file a freight claim. On June the 20th, Net Solutions sells merchandise to Planner Company on account, $800, terms FOB, shipping point. Net Solutions paid freight of $45, which is added to the invoice. The cost of the merchandise sold is $360. So let's take a look and see how we would actually record this sale. We debit our accounts receivable, $800, and then credit our sales $800, debit our cost of goods sold, cost of merchandise sold $360, credit merchandise inventory $360, and then debit accounts receivable, planner company $45 and credit to cash $45. So we would actually pay the shipping, but we'd collect it back from the buyer. And this just tries to explain the FOB destination, FOB shipping point. FOB destination, the title doesn't change until the buyer receives the merchandise. FOB shipping point, the title changes when it's delivered to the seller, and the buyer actually pays the shipping cost. And FOB destination, the shipper pays the shipping cost. So now we're going to take a look at another example exercise, and this is exercise 6-5, which is on page 271 in your book. It says determine the amount to be paid in full settlement of each of these invoices, A and B, assuming that credit for returns and allowances was received prior to payment and that all invoices were paid within the discount period. So the first one, we've got an invoice for $4,500, and the freight, it says this is freight is $200, and then the terms were FOB shipping points. So who's going to pay the freight in this case? FOB shipping point means the buyer is going to pay. So the buyer is going to have to pay the $4,500 plus the $200 minus the $800 returns and allowance, and then they will get a 1% discount if paid within 10 days. And the second one, we've got a $5,000 worth of merchandise, $60 worth of freight, and this is free on board destination, which means the seller is going to pay the freight, so the freight won't be involved in this one. This one had a return and allowance of $2,500. So let's take a look and see how this works out. In the first case, the amount of cash to pay would be $3,863. We had a $4,500 purchase less the $800 of returns. It gives us $3,700. We had a 1% discount, so we subtract $37 from the $3,700. I'm sorry. Oh, okay. Plus we had to pay the we had $3,700 plus the shipping $200, so we've got $3,900 minus the $37 discount would give us $3,863. In the second case, it's $2,400 because we had a $5,000 purchase, but this one was let me flip back. I think this one was FOB destination, which means the seller's paying the freight, so the freight's not involved. We just take the we had a $5,000 purchase minus $2,500 gives us $2,500, and then we take a $50 discount and pay $2,450. Pretty simple, right? Could never get confused on something like that. Now we're going to talk a little bit about sales tax. It says on August the 12th, merchandise is sold on account to Lemon Company for $100. The state has a 6% sales tax. So we're going to debit our accounts receivable for $106. 6% of 100, $6. And so we're going to credit our sales for $100 and then credit our sales tax payable for $6. Says on a regular basis, the seller pays to the taxing authority the amount of sales taxes collected, and so when they pay that, they would debit the sales tax payable, in this case $2,900, and credit their cash $2,900. Trade discounts, when the wholesalers offer special discounts to certain classes of buyers who order large quantities, these are called trade discounts. And you have some wholesalers out there that have different tiers. You know, some customers may get a 10%, so other customers may get a 15% or 20%, so they have different tiers that they offer. But we're going to stop at this point, and we'll pick back up because our time's up. We'll pick back up and talk about the dual nature of merchandise transactions. Thank you, and have a great day.